Hey guys, so in this video, I want to give you my top 5 tips for investing throughout multiple different industries, multiple different asset classes. My top 5 tips that I've learned along the way for 10 plus years of investing. And I feel it's very important in this market that we're in, with this new economy that we're in regarding real estate, crypto, and the stock market. I'd like to go over my top 5. So stay tuned. We're gonna hit on all 5 of them, of my personal experiences of my best tips. All right guys, so welcome back to the channel. If you guys don't know me yet, my name's Kyle Claus. I'm a professional actor, real estate investor, real estate business owner, broker. I have multiple offices and we have many agents at these offices. I'm also a very involved investor amongst different markets, and I wanted to go over my top 5 tips today. So before we get into it, if you take a quick look below, hit the like button. It helps with the YouTube algorithm. I appreciate it very much. I'm not doing this for anything other than just your added benefit, to help out and try to give back of what I've learned and the knowledge I've learned and the mistakes I've learned along the way, to try to help you avoid those pitfalls. So let's get right into it. All right, so my number 1 tip in investing, no matter what you're looking to invest in, is diversification. Now, some people might say, trust me on this, this is truthful experience. Yes, could you earn more money by dumping everything you have into one stock, into Apple stock back in 2000, the year 2000, if we had a crystal ball? Maybe you could, but here's the thing. To get that right, I don't think any human in history has been able to do that. So my experience and my advice, this is not financial advice, this is just what I've experienced along the way, is it's better to diversify amongst multiple topics in each individual industry. So for instance, if you're investing in real estate, could you go all in on an asset, on a appreciation play, buy something in New York City and hope it goes up faster than anything else? Now you're sitting on this piece of property that's worth more than anything else. Could, yes. But my suggestion is, if you're getting into real estate, to diversify within real estate itself. What I mean by this is, look at cash flow properties. You might need to look outside of your area. For instance, in the New York, North and New Jersey area, you're not going to find too many cash flow properties unless they're dilapidated and you have to fix them up, or they're in up and coming areas that are a little, like outside of your range of where you feel comfortable. But you might look outside in different states, or where your hometown is from, or maybe right around where you're living now. There are certain areas where the cash flow equation is so much greater. So number 1 is look for different opportunities in real estate. You might want to diversify, allocate a portion of in cash flow properties. What I mean by this is, maybe you find a property that's worth $300,000, that's a multifamily, that you can buy, and your mortgage is $2,000 per month, but the rent return is going to be $3,500. That's a cash flow property. You're making $1,500 on top of your mortgage each month. Another allocation is, maybe I want to break even monthly, but I'm going to get this in the most desirable area that I think is going to, maybe there's a train, something that in your knowledge base, that maybe this is an area that looks like it's, there's a Netflix industry that's going on. There's an Amazon building that's going to, warehouse that's going to be built there. I remember when Amazon was coming into Long Island City in New York, prices skyrocketed overnight. So being able to, identify those kind of properties. For instance, I know a town in Pennsylvania that there may be a train coming in that's going to go to the nearest metropolitan major city. That might be a good opportunity to get in right there, if you find a good investment, to get in for an appreciation play. The next thing you might be able to do is like a syndication, where you're coming in with a whole group of people. You're not even worrying about tenants having to lease them out to something. You're not worrying about any of that. You're just basically coming in with somebody who's going to manage a property either in your state where you can go visit it, or in a Texas or, some other property. They're all over the place, and you can go in with them, put a capital allocation in, and they're managing, they're doing everything. Now your returns might not be as great, but it's another thing where you can just literally sit back, don't do anything, and you're just collecting checks every month or every couple months. The diversifying, now if you're talking about stocks, diversifying in stocks, maybe you're making a Tesla play where you're like, all right, this thing is going to double, triple. MicroStrategy, where you're thinking, okay, MicroStrategy is a company that's making that. Like, this is one of the examples that I had. MicroStrategy is a company that's producing cash, but they're also holding Bitcoin on their balance sheet. I think, without listening to talking heads, that's going to be a good appreciation. Now, I might think that thing is going to 10x, but I'm also going to diversify in dividend plays. I'm also going to play safer plays, which are like maybe the Apples, where now they're a $2+ trillion market cap. They're going to grow year over year, but it may not be as big as a emerging company that's going to, double, triple, 10x. So that's diversifying within diversification. Even in crypto, you're talking about, my biggest thing is I'm a biggest believer in Bitcoin, but maybe that's 80% of your portfolio. The other, just in case, 10% is Ethereum. Maybe the other 5% after that is Solana. Maybe you have 5 other percent into meme coins and whatever have you, that it might 100x. So that's what I mean by diversification is very important in each industry. So my number 2 tip in investing is don't get left holding the bag. If you are investing in something, I'll give you an example. I first got introduced to stock investing, and I thought, on my own self, that pot stocks at the time, because pot was becoming legal in Canada, and there was talks about it being legalized in the United States, and this is an emerging industry, just like, when Prohibition had alcohol, and that was, so I had a good thought process with that. And upon buying those, they 10x'd. And it's easy to think that euphoria is going to keep going on, that this might turn into a 20x, 100x return. Well, my best experience with that is don't get left holding the bag. I knew deep down inside these pot companies were probably a sham. A lot of them were. And now you get looked at, looking at what else is out there that's a smaller company that's going to 100x. Could be a sham. The point is that no one's going to ever blame you for selling at the very top. Or if you don't think it's the very top, here's my best advice. Don't get left holding the whole bag. So for instance, I'll give you an example. MicroStrategy. I had that example about where I thought, okay, they're holding it on the balance sheet, by about 10,000 worth, and now it's 10x to 100,000. Well, do I think it might go up? Has anything changed in that game plan? Is Bitcoin going to still go up? Are they still a good company that's income producing? Yes, they are. But they are also subject to the stock market as a whole. If any geopolitical things happen, something like that. So now, instead of selling your whole entire thing, and now if that doubles, you're left stressing out and being very annoyed at your decision. You cannot be left holding the bag just by going, okay, I'm going to sell a portion of this because it's rising, rising, rising. Nothing goes up in a straight line forever. That's my advice. So it's no problem taking a portion of profits and sitting back and then letting the rest ride with essentially house money. And then if it keeps going up, decide logically when you might want to take a little bit more, and so on and so on. Number 3rd piece of advice after that is to take emotions out of it. So exactly in my example of the MicroStrategy, where it keeps going up, or in the pot stocks, it's not going to go up in a straight line forever. Nothing does. Something happens. It might not be even that company. It might be the market as a whole, the industry as a whole, something else, political, war or something like that, God forbid. But the point being is this: take emotions out of it. Set something rationally in your mind that, okay, if this goes up to, from 20 to 100 per share, I'm going to take a quarter of it off. Now you've easily made your money back and you're letting the rest ride. Now, if that goes up to 150 a share, I'm going to take another quarter off. Boom. Now, if that goes up to 200 a share, I may take off 10% more, and so on and so on, because eventually that will come down, and now your dollar cost average is going to be much better by doing it that way. And even if it doesn't come down, you still have are still allocated, and you still have some skin in the game, so you feel good about it. Okay, so now my number 4 piece of advice: don't listen to the talking heads. The talking heads are paid to talk. They will give their opinion on so many different things. Have you ever heard of the inverse Cramer? The inverse Cramer strategy, where everything Jim Cramer says on CSNBC, you go against it because he's wrong so many of the times. He's paid to talk. Now, use your own intuition on this. So don't listen to the talking heads. A couple of my best investments initially back in 2011, 2012 were Amazon and Netflix. And you know why? Because I thought, this Netflix is taking down Blockbuster. This is starting to go digital. That may grow. For Amazon, I mean, they were talking about drones delivering packages. I just thought that was very innovative. It didn't really happen yet, or it might have. But regardless, they grew, and they were an innovative company. So having something like that, use your own intuition. With MicroStrategy, thinking about it beforehand of going, Michael Saylor's buying up all this Bitcoin. They're still a good company. Their stock is very low and it hasn't gone up so much yet. If I think Bitcoin's going to raise, and using your own kind of hypothesis and your own thesis, I think Bitcoin's going to raise. Well, I think MicroStrategy is still a good company. They keep going up. They're a cash flowing company. Now put 2 and 2 together and don't listen to the talking heads thinking it's overvalued. Now you're making good intuitional decisions for yourself. And a lot of times I found that those are way more right, and I've gotten those way more right than listening to talking heads and thinking I'm missing out on something else. Okay, so my 5th and final biggest piece of advice and tip when investing is don't sell. All right, so it's not a one blanket piece of advice, but my best example of something personally, instead of I'm not giving financial advice here on what you should do with your own stuff. I'm just saying from experience, the best things were things that I never sold. So getting into the whole nitty gritty of, okay, this went up a lot, I'm going to sell everything. Yeah, maybe you pick it right at one point, but then you might not pick it right the next time, and you're going to get so much in your head. So my best piece of advice is from my own experience was to not sell. And that means, like I said before, if something goes up a whole ton, you can take a little piece off, that you're not going to be annoyed at yourself if that keeps going up forever. You know, something like Bitcoin, something like Apple stock, something. I've seen people friends of mine who have had invested 100,000 in Apple stock and it turned into $1 million and sold the whole thing, and then started trying to buy other things to make up more money. But instead, if they would have just done nothing, that Apple stock from $1 million would have doubled to $2 million and then some, without really having to do anything or stress or think or, make other mistakes. So my biggest piece of advice with that from my own experience, and not telling you what to do, is to take a real look and, other properties that I've had, that I've sold, that if I would have just waited for a year or two, they would have maybe doubled in price. Because really, over the long term, everything kind of keeps going up. And if it's a good asset, if it's real estate, if it's a good crypto, not a bad crypto, if it's something you believe in, a golden opportunity for the long term, a great stock, a great company, more than likely, it's going to have dips, ups and downs, but it's going to keep going up in the long run. Okay, guys, so that is my top 5 tips from my own experience. Not letting you know what to do with your own thing. That's for you to decide. But my best piece of advice with everything is to stay informed, stay focused, stay learning. and just learn and focus more on these kind of things when you're looking at your own investments, and just stay with it and don't lose track of what the main target is. Life is long and you have years of investing to do. So it's always best when you're in it for the longer term. So guys, thank you so much. Again, this is just a video to try to help out things that I've learned along the way, and take it for what you will, and apply it where you think it might be most beneficial. Guys, thank you so much for tuning in. Please hit the like button if you haven't already. That's the only thing I really ask out of this video. I'm doing this basically just for my own, to help out. And subscribe if you have not done so already. Hit the notification bell so you get notifications every time I post a new video. And guys, thank you so much for tuning in. Until next time, peace.